Hey there, knowledge seekers. Ready to unravel the mysteries of corporate financial.
Always up for a challenge.
All right, let's imagine for a second you're navigating the stock market. You see all these company reports promising growth, dazzling growth even, and prosperity. But what if, and stay with me here, what if those profits aren't as real as they seem?
Now that would be a problem.
It would. And that's where this idea of creative accounting comes in.
It's like a magic trick.
Exactly. Think of it like a magician's sleight of hand, a way for companies to make their numbers look better than they actually are. Perfectly legal, by the way.
So where do we even begin to untangle that?
Well, that's why we're here. We're doing a deep dive with Accounting for Growth by Terry Smith as our guide.
Oh, Smith's a veteran. He's seen it all.
Exactly. He knows exactly where to look for those hidden red flags, and he doesn't hold back. What I find fascinating is these techniques, these aren't just for, Wall Street hotshots. Even if you're not someone who pores over company reports, understanding these tactics can make you a savvier consumer of financial news in general.
Absolutely. You've got to be able to read between the lines.
Exactly. So let's start with something basic. Profit doesn't always equal cash flow. It's like that friend, the one who's always bragging about their big dreams but can't even spot you for a coffee.
I know that friend.
We all do. And Smith, he uses the example of Brentford Nylons, this company back in the 70s. Seems like they were raking in the profits, even had a celebrity spokesperson.
Sounds of a sure thing.
Right. You'd think they were golden, but they went bust because they weren't generating enough actual cash to cover their expenses. It's a classic case of smoke and mirrors. That's why cash is king, right? It's not about the numbers on the page, but what's actually flowing in and out of the bank account.
What you're actually working with.
Exactly. And Smith, in this book, he lays out this whole arsenal of creative accounting techniques that companies use to make their profits look better than they are. And we're gonna tackle each one, peel back the layers of the illusion here.
Sounds like a plan. Where do we start?
Well, we're gonna dive into things like playing games with, get this, extraordinary and exceptional items.
Okay, now those sound like accounting buzzwords.
Oh, they are. They're supposed to be these rare events, but some companies, they get creative with how they categorize their expenses.
Wait.
Totally. We'll also explore, and this is a big one, off-balance sheet financing. That's where companies try to actually hide their debt from investors.
That sounds, well, risky.
Oh, it can be. And we'll dive into the art of capitalizing costs. It's a technique that's particularly popular in property development, right?
Oh, I see. So it's about timing.
Exactly. It can make a company look way more profitable in the short term. But, and this is the question, what if that asset doesn't actually, appreciate in value like they're hoping?
Good question. Then what?
Then it's all smoke and mirrors. We'll also look at brand accounting, which is fascinating. That's where a company's brand name actually becomes like an asset on their books.
Well, that's how companies like, say, Coca-Cola justify their huge valuations.
You got it. We'll also delve into depreciation, which sounds boring, but it's actually this magic trick of tweaking the lifespan of an asset to, boost that bottom line.
Tweaking the lifespan. Right.
Exactly. It's like saying your old car will last forever just because you say so.
I like that accounting.
Right. And then there are these things called, get ready, convertible bonds with put options and AMPS.
Those sound intense.
They sound like something out of a financial thriller, right? But they're real, and companies use them to their advantage. We'll break those down. We'll also explore pension fund accounting, which is a whole other beast.
Always wondered about that one.
It's surprisingly complex, but we'll make it clear. And finally, we have to discuss currency mismatching. This is where companies, it's wild, they exploit the differences in international interest rates.
Okay, that one went right over my head.
We'll unpack it. It's risky business, but some companies use it. We'll break down how it works and what the potential pitfalls are.
Sounds like we've got a lot to cover.
Oh, we're just getting started. You ready to dive in?
Let's go. Ready to go deeper.
Deeper we go. We were just getting to the good stuff, right? I feel like we just dipped our toes into the water.
Okay, well let's dive right into a story that might actually make your jaw drop. You remember Enron?
Enron. How could anyone forget Enron? That whole scandal, it rocked the financial world.
Textbooks were rewritten after Enron.
No kidding.
Okay, so they were masters at this. Masters of off-balance sheet financing. Hiding, get this, billions with a B, billions of dollars in debt. They use this web of these partnerships, these complex partnerships.
So it's like They were creating these shell companies, these phantom companies, just to make their numbers, their financials, look all squeaky clean.
That's exactly it. And it worked. For a while, at least, investors, they were totally fooled by these impressive profits. Until, of course, the house of cards came crumbling down.
Right. And that's why I think this is such a powerful reminder. Understanding these techniques, these accounting tricks, it's not just about, being a financial whiz. It's about protecting yourself.
100%. So let's unpack another one that's especially relevant, I think, to everyday investors. And that's this idea of playing games with extraordinary and exceptional items.
Okay, I'll be honest. Those terms, they still sound like, I don't know, like accounting jargon to me.
Yeah, they're a mouthful. Okay, so imagine this. A company, they're going through this big restructuring, right? They're going to have costs, significant costs, layoffs maybe, closing down factories, things like that. Now, these costs, they're real, but they're not part of, like, the company's normal everyday business.
Yeah, it's not like their electric bill or something.
Right, exactly. It's more like a one-time expense. One time, hopefully.
Fingers crossed.
Right. And so here's where the creativity comes in, right?
Mm-hmm.
Companies, they get to decide. They can choose to call these costs, classify them as extraordinary or exceptional items.
Okay, and what's the advantage of doing that? What's the difference?
Well, here's the thing. These items, these special items, they're often excluded from a key measure of profitability. It's called operating profit. And so by classifying those costs, those restructuring costs, as extraordinary, boom, suddenly that operating profit, it looks way better.
Ah, so it's like they're airbrushing their financial statements, making things look prettier than they actually are.
In a way, yeah. I mean, Smith, he gives this example of this company. They classified, get this, the cost of moving their headquarters as an extraordinary item. I mean, yeah, moving offices, it's pricey, it's a pain, but is it really that unusual for a company to move? Especially if they're growing?
Right. Companies move all the time, so it's not exactly this, like, once-in-a-lifetime event.
It's not like an earthquake or something. So that's why, you got to be skeptical. When you see those items on a company's income statement, do your homework. Dig into those footnotes, the fine print. Ask yourself, are these truly extraordinary?
Mm-hmm.
Or is this company trying to just, like, sweep some embarrassing expenses under the rug?
Okay, so it's all about context and not just taking things like at face value. What about capitalizing costs? We touched on that earlier. You mentioned that's a big one, especially in like real estate and development, right?
Huge in property development.
Yeah.
Okay, so picture this. You've got this property developer. They're building, say, a massive shopping mall, right? They're going to rack up a lot of expenses just during the construction. Materials, labor, permits, all of it. Huge costs.
Mm-hmm.
But here's the thing. They don't have to write those costs down all at once.
Wait, really? What do they do instead?
Okay, instead of just expensing them immediately, they can do this thing. They can add those costs, to the value of that shopping mall on their balance sheet. And that's capitalizing those costs.
Okay, and then what happens? Like when that mall is actually, built, open for business?
That's where the magic really happens.
Yeah.
They've got this shiny new asset, right? This big old mall. And the value of that mall, on their books at least, includes all those costs. All those capitalized costs from construction. And get this, they can gradually, over time, deduct those costs.
So they're spreading it out. Instead of taking one big hit to their profits, they're kind of drizzling it out over, like, what, 20, 30 years?
Exactly. Makes those short-term profits look really good. But, and this is a big but, what if that mall, it doesn't make as much money as they thought it would? What if stores start closing? Or the economy tanks?
Yeah, then what?
Then those costs, those capitalized costs, they become a problem. A liability even.
So it's another one of those like buyer beware situations.
100%. You got to be cautious, especially with companies that lean heavily on those capitalized costs to boost their profits. Might look good on paper, but
But it might not be built on the strongest foundation.
you got it.
Yeah.
What else is on your list? We can talk about brand accounting next. That one's always a head scratcher.
Yeah, brand accounting. I mean, how do you even put a price tag on something? Like a brand that's like, what, putting a value on like coolness or something.
Right. It's intangible.
Great.
But companies try.
So we left off talking about how companies play with currency, something called currency mismatching. What is that exactly?
So imagine a company borrows a ton of money.
Okay, they're in debt.
Right. But here's the thing. They borrow this money in a currency with super low interest rates, like, say, Japanese yen.
Okay, so they're getting a good deal.
Right. But then they take those yen, They convert them, let's say, to Australian dollars, where the interest rates are way higher, and they invest that money in bonds.
So they're like playing the system, trying to make money off the difference in interest rate.
Exactly. It's like arbitrage, trying to profit from that gap. But, and this is a big but, exchange rates.
Yeah.
They can change like the wind. One day the yen's weak, the next it's strong. So if suddenly that Japanese yen gets strong against the Australian dollar, that company, they could lose a huge chunk of those interest gains when it's time to pay back that initial loan.
Ouch. So it's a gamble.
Big time. Smith talks about this company, Frasons, a pharmaceutical company. They were reporting all this net interest income. Seemed like they were making bank, but they also had a lot of debt. Turns out, currency mismatching. It's a house of cards.
So, red flag. If a company, if their interest income looks too good to be true, especially with high debt, time to dig deeper, look for that foreign currency exposure.
Exactly. You got to connect the dots.
Yeah.
Now, before we wrap up, and we've covered a lot of ground here, I do want to say, creative accounting, it's not always, some evil scheme. There are legit reasons companies use these techniques.
Yeah, it's not like illegal or anything, right? We said that.
Right. Sometimes it's about making the company's performance look smoother, more consistent over time, like evening out the brunks, or reflecting the real value of things like their brand, intangible stuff.
Okay, that makes sense. So it's more about transparency then.
100%.
Yeah.
Companies, they should be upfront about what they're doing, why they're doing it, and investors. We've got to stay frosty, ask questions, look beyond the highlight reel.
Don't be afraid to be annoying.
Exactly.
So where does this leave our listener? We've gone through the looking glass here into this world of creative accounting. We've seen the techniques, the tricks, the whole playbook.
It's a lot to take in, but hey, knowledge is power, right?
Right. The more you know, the better equipped you are to, to spot those red flags, make those smarter investment decisions.
Couldn't have said it better myself.
Yeah.
And remember, cash is king.
There it is again.
Don't be fooled by profits that look amazing on paper if the cash flow doesn't back it up.
Run for the hills.
Pretty much. And, don't just read those headlines, dig into those footnotes, the fine print. That's often where the real story is.
Yeah, those footnotes are your friend.
They are. And don't be afraid to, like we said, ask the tough questions. If something seems off, or those accounting practices, if they set off your spidey sense,
trust your gut.
Trust your gut. There are plenty of fish in the sea, plenty of other investment opportunities out there.
This deep dive, I feel like I've learned so much. We've learned that creative accounting, it might be legal, but that doesn't always mean it's, on the up and up.
It was a gray area for sure.
Totally. If even the pros, the experts, if they can be fooled by these schemes, like what happened with Enron.
Right.
How can we, the average investor, how can we protect ourselves? How can we make sure we're not getting taken for a ride?
It's a tough one. Takes a lot of research, a lot of due diligence.
That's something for all of us to think about.
Hey.
That's going to do it for this deep dive. Until next time, happy investing, everyone.